I am Lohit. Presently, I am studying in SRIT College, second BTech Mechanical Engineering. And today I was explaining about one of the topic in industrial management. The topic name called payback accounting return of a period. So you can look into forward about this topic in industrial management. So introduction to the payback and ARR. So payback and accounting rate of return. So what is the full form of ARR? Means accounting rate of return. So payback and accounting rate, these are the one of the techniques in industrial management which is essential for the planning their profits and losses, to managing their accounting in the industries, and they helps to the business and profitably and investments. Understanding these concepts is also crucial for the financial decisions to earn the profits in the company. And you can see the formula there for calculating the account rate return, and total net profit and the number of years and the initial cost into 100. You can get the percentage over there. And if you want to deeply if you want to know about clarity, and you can look in you can take the screenshot, and you can see their example project. The total net profit for 5 years equals to 13 lakhs 50,000 euros, and divided by the project life. So project life was 5 and 5. If you watch divided by these guys, you can get around 2 lakh 70,000 euros, and divided by these, you can get the percentage of profit. So next, what is payback period? The payback period is measured the time required to cover the initial investment, and it is the straightforward calculation that provides the quick insights into the cash flow. And business often uses the metric to assume the risk of an investment. So for calculating this payback period, and when the cash inflow or the even equal when the cash flows for the all year equal, you can use the following formula. The formula for the payback period, uh, is like the formula for this payback period was initial investment by annual cash flow. And you can see, and you can take the screenshot, and you can deeply know about it. And for the calculating of payback period, to calculate the payback period divided by the initial investment by the annual cash flow, this will the years of needed to the recoup the investment. And a shorter payback period is generally preferred in the indicates that a lower risk. And the formula for the payback period was initial investment or original cost of the asset divided by cash flow. We can get the payback period value. And the limitations also has there for this payback period. The payback period doesn't consider the time of the value of money. So you can on the time the value of money, you can't decide what is happening there. So it also ignores the cash flow that occurs after the payback period. Also you can get there is some limitations also there in this payback period, and these limitations can be lead to the incomplete assessment of investment probability. So ignores the time value of money. That was the one of the limitations of this payback period. And another one is it does not consider the cash flow beyond the payback period, and no connection between the maximum acceptable payback period and the shareholder requires to the rate of returns. So these are the limitations of this payback period. And next one, our next topic was account rate of return. This has the formula of total net profit of number of years, and like initial cost. So I'm already explained about this. And for calculating this also very similar to this that one also. And we can see here like examples, and for the examples and the formula. And next, and this has also one limitations. Account rate return does not account of time value of money and like other method, and it can also misleading. The profits are inconsistent over time. The metric value fully reflect the risk associated with the investment. And we can also calculate the differences between the IRR and ARR. and you can take the screenshot and look it into furtherly, and we can compare these payback period and account rate return. Both metrics provide the insights but focus on the different aspects of investment, and the payback period emphasizes the cash flow recovery, and ARR focus the probability, and both can make the comprehensive view of investment. So we can these are the comparison between these payback period and account rate return. Both provide the investment and profit, and the payback period emphasizes cash flow and recovery while the focus on probability. So you can see here, and which use each metric. The payback metric useful for the assembling liquidity and risk short-term project, and account rate return more suitable for the evaluating the long-term investment and probability, and decision makers should be choose the metric that have. And finally, I have to conclude that understanding both payback and account rate return is vital effective in the industrial to run it comfortably and making profit by these techniques. And each metric has the strength and weakness, and you have to know about it, and how to use these techniques while performing and manufacturing the products. And this also plays the vital role for understanding of these both techniques, and a balanced approach use the both metrics leads to the better financial decisions. And also we can make the by using these techniques we can make the better financial decisions in our company, and run in the profitable way. And by this I have to stop this video, and thank you. Have a nice day, guys.